Good afternoon, ladies and gentlemen, and welcome to today's webinar. My name is Guillermo Sanchez, and today I will be explaining to you the fundamentals of online trading, essentially about CFDs, contract for differences, what they are, how they work, and also I will be giving you some examples in order to give you more clarity when it comes to CFDs. Then I will be also explaining to you what is leverage and also margin, which again is fundamental for the CFDs. Then after that, I will be just giving you some of what are the advantages and disadvantages of CFDs. So that would be the first part of this webinar. Then for the second part of the webinar, I will be explaining to you, or we will be discussing about what is Forex trading, how it works, and all the advantages and disadvantages. Also, I will be giving you some example on how to read currency pairs. Then I will be showing you, the different type of contract sizes that are available for, when you're trading Forex. Also, we'll be also telling you about how to trade other instruments such as oil and gold. It will be just briefly. I won't be too much into detail because, again, as I mentioned before, today's webinar is purely about the fundamental of online trading, and that's it. Obviously, then tomorrow I have another webinar, which is a bit more, it's how to trade on the platform, on the trading platform called MetaTrader 5, and in there I might have some other strategies where you can see, not just how to place a trade, but also other type of strategies that you can do when you're trading CFDs. But let's just stick with the basic. So once I explain to you everything about Forex trading, then at the end, if you have any sort of questions, please do ask me, and I'm more than happy to answer them. Also in between time, if I'm going too quick or there's something that you didn't understand, don't hesitate to ask me. Just drop the question on the chat box, and as soon as I see it, I will be able to answer them. Obviously, if I believe that maybe I can answer that question later at the end of the webinar, I will let you know. But yeah, so if you have any questions anyway, please do ask me. Then yeah, as soon as I see it, as I said, I will be able to answer them. So, okay, let's now moving on. So what are contract for differences, or also as it's known as CFDs? Well, essentially it's an agreement between the exchange price of an asset, let's say gold or oil, when the contract's open and when the contract is closed. And this in turn, ladies and gentlemen, help you to speculate on the price movements of the financial markets, and without actually owning the underlying asset, okay? And just bear that in mind. When you trade in CFDs, you're not gonna receive any sort of certificate, for example, as is in the case when you trade in the cash market. Here with CFD, you simply trading the price, okay? So let's say, for example, that you believe that the price of gold will go up anytime, let's say in the next couple of minutes. Then if you believe so and you want to trade it, you go ahead and buy gold, okay? But all you do is just hoping that the price will go up, it will go in your direction, so you will make some money. Conversely, if you believe that the price of gold will go down, then all you have to do is sell gold, and then if the price goes in your direction, you also make money, right? So that is the main reason why we like to trade CFDs. It's mainly for speculative purposes. Also, CFDs are derivative products. So as I mentioned, as you probably guessed before, their prices are dependent on the underlying assets to which they're linked. So in this case, gold. In my previous example, as well, you can trade not just metals, but you can also trade commodities, indices, equities, and Forex with CFDs. And then, another thing, ladies and gentlemen, this is just a trading terminology, which is, as you can see over there, buy long. That basically means that when you buy, you might hear me a lot saying long, okay? So that means I'm buying, and when I say, or if I say short, that basically means I'm selling, okay? So let's say, for example, in my previous example, with the gold price, you believe go up, you go long, okay? So you see, in other words, you buy. Cool, okay, so I hope that is clear. So, okay, so next step is how to see if this work. So, well, essentially, CFD allows you to open a position with a small percentage paid in capital, a small percentage in capital paid on front in some sort of deposit. So let's say, for example, here, as you can see over here, we have here this little chart of the Dow Jones, right? Let's say that the price, the current price of the Dow Jones is $100. So if you like to trade this particular index, you normally, if you go to a bank, you will have to put the full amount. So in this case, it's $100 of your money that you have to put in order to be able to open that position. However, with CFDs, you will need to put the full amount, okay? That is one of the advantages of CFDs. So all you have to do is put a small percentage. Sometimes it will vary. It's not always fixed. I will explain to you later on why it might vary and how you would know what is the percentage that you have to put in order to put open that particular position. So with the so sometimes it could be 10% or 5% or more or less, you know, depends. So let's say, for example, here would be 10%. So in order to open $100 worth of one of the Dow Jones, all you have to put is $10, okay? So here's an example of what I was saying before. So the notional value of the position in this case is $100, but in order to open that position worth $100, all you have to put is $10. Why? Because, well, in this case, I will explain to you in the next slide. My leverage is. Before we get into that, so basically that is because, well, when you try to see if this, you got there's a percentage, okay? So just make things simpler. You have to put only 10% of the full notional value. So in this case, it's $100. All you have to put is $10. Okay. So let's say, for example, if the price was $1,000, all you have to put is $100 in order to trade that particular position. Also, any losses and profit will be based on the full notional value. So in this case, will be based on the $100. Okay. No, it will not be based on your initial deposit. Okay, so let's say, for example, is a price is at the moment 100, but you went long, so you're hoping the price will go up. So let's say indeed the price went up by $1, so $101 is the current price of the Dow Jones. Then you will have made 10% already in profit. So it will be $1 since you already put the initial deposit was $10. So your account balance, let's say that was your full account balance, it will just go by 10%. So yes, so that is how CFDs work. Okay, now I will. What I wanted to say before, how would you know what is this percentage that you have to put, you know, in order to trade? In this case, from our previous example, the Dow Jones, is all down to the leverage. Okay, so essentially leverage enables you to increase your buying power of a particular position by simply depositing a small amount in capital, okay? Usually leverage is expressed in ratio, So you will see a lot. So here with CFI Financial, once you open an account with us, a live account with us, we will be sending you a confirmation email of all the specification of your account. And in there, we will show you what is your leverage. So you might see it as 30, 1 to 30, 400 to 1, etc., so on. Okay, so obviously you will have to pay a close look in that, because that will actually tell you how much money you have to put in order to open that particular position. So let's say, for example, that your leverage was 100 to 1. So if the current price of the, let's say, the Dow Jones was $100, all you have to do is simply divide 100 by 100, so it would be $1, right? So all you have to put of your money is $1. So let's say, for example, that your the current price of the Dow Jones is, let's say, $1,000, but your leverage is 400 to 1. All you have to do is divide 1,000 by 500, and the result will be 2. So then you have to put only $2 to open one position. Obviously, if you want to deposit to open 2, 3 more positions, all you have to do is just divide that, right? $2 by 2 or 4, depends how many positions you can actually open. Okay. So that is why leverage is very, very important, because that will tell you how much money you have to, how much, well, your buying power, right? So the higher leverage, the more buying power, the less money that you have to put in order to open that particular position. Okay. And the margin, which is basically, it is a minimum amount in capital required to open a position. So it's essentially all it is the money that you have to put in order to open that a particular position. I know it's very similar to leverage, but they are actually intercorrelated. Okay, so it's not really the same. Also, margin is usually expressed in percentage. But again, ladies and gentlemen, once you know your leverage, that should be enough. Like I mentioned to you in my example, all you have to do is divide the notional value of the position by your leverage, and the result is basically the amount that you have to put to be open that position, okay, which essentially is margin. So I hope that made sense. Okay, I see that we have no question at the moment, so that is very good. So okay, so let's move on with the advantages and disadvantages of CFDs. So well, one of the major advantages of CFDs is that they offer a higher leverage, which can help you to maximize your profit, since any profit, as I mentioned before, is based on the full size of the contract. Okay. So, well, previous example, if it was $100, that is based on that, okay? Not on the initial deposit, which was, in that case, was $10. No, we're not based on that. It's going to be based on the full size. So in this case, $100, okay? Also, CFDs give you access to the major financial markets in the world. As I mentioned earlier on in the beginning of the presentation, you can trade pretty much everything with CFDs. Everything from currencies, commodities, metals, indices, and also equities. So you can also trade stocks, not just in Europe or here in the UK, but you can also trade stocks in the US and in some of the Asian exchange stocks as well. Okay, and also one of the advantages as well of the CFDs, unlike futures and option, or if you're based in the UK, spread betting, is that the contracts do not have an expiration date. So that means that you can hold the position as long as you want, without worrying about, oh, when do I need to close my position to simultaneously open up again, which is in the case of futures and options. So that is also another good thing about CFDs. So yeah. So you have that, and then obviously with the disadvantages though, CFDs are considered to be a high risk product. So basically you can lose all your investment. And the reason for that, and I will give you here an example why you can lose all your investment when you trade in CFDs, is because, as I mentioned a few times before, any profit and loss is based on the full value of the contract. So even though you have to put only a small deposit of your money to be able to open that position, the losses will be also be based on the notional value of that position. So let's say, for example, just taking again our previous example of $100 of the Dow Jones, that is the current value of Dow Jones, $100, and you only have to deposit $10. So let's say, for example, that you went long, so you wanted the price to go up, but things are happening in the market. Sometimes the market will go against you. So let's say the price of Dow Jones went from $100 to $90. Okay, so obviously, see, you have to deposit 10% of that, so $10, and the notional value, the full price of Dow Jones went down by $10. Then that would have mean that your account will have been in zero. Obviously, sometimes your account can also even go into negative balance. So if the price was going by $20, so it would be now $80, and you only had to deposit 10%. So obviously, your account would now be minus 10. But I don't want to go too much into that because that will vary, depends on your jurisdiction. Some companies are regulated by different financial regulators, so they have different type of rules. So that I will explain to you at the very end of this presentation. But yeah, I just want to explain to you why you can lose all your investment when you trade in CFDs. So yeah, it's all the reason why. Okay, but there are so many ways that you can avoid this from happening, and there are so many trading strategies, also the way you manage your risk as well, which again I will explain that to you if you're interested. I'm having another webinar tomorrow at the same time that I will be briefly explaining these situations that how you can prevent from this from happening. So if you haven't registered for that webinar, please, you can do so by going into our website, cfifinancial.com. Go into the section says education analysis. Then you will have another options, click and learn how to trade. And in there, you will see all the webinars that we actually have. We run webinars every day, but yeah, for this one in particular will be tomorrow at the same time, 4 p.m. London time. So if you're interested, please do sign up, and tomorrow I will see you there as well. So, okay, so before we move into the second part of this presentation, I can see that we have here questions. So the question is, we can make also profit. Yes, you can also make a profit when you trade CFDs. I just wanted to let you know, the disadvantage of CFD, because it's a reality. Okay, you can lose all your investment, but don't think that is a bad product. The CFDs are not good for you. Obviously, we depend down to your own needs and requirements. But yeah, you can also, same way you can lose all your investment, you can make even double, triple, quadruple your money, right? So, but yeah, just I just want to be clear, because it's not just all about making money. You can also lose your money, and that's just a theory. But again, like I mentioned before, there are so many ways that so many trading strategies that actually help you to avoid losing all your investment and trying to maximize your profits over your losses. Okay, so yeah, that is good. I hope that made sense. Yeah, you're welcome. No problem. Again, ladies and gentlemen, if you have any questions, please do ask me anytime. But yeah, if at the end of the webinar you still have more questions, I'm more than happy to answer them as well. Okay, perfect. So now moving on. So what is Forex trading? You probably heard a lot about Forex in the news, particularly in the last year or so, especially with this, that everything's happening right now in the world. So obviously, trading has been very common between even new incomers and new traders that got some interest in trading. So now they obviously want to learn more, and that also has increased the volumes, the trading volumes of Forex. So essentially, Forex is a global decentralized market where you can trade the value of one currency versus the value of another currency. So let's say, for instance, the euro versus the US dollars. And one of the main reasons why you would like to trade in forex trading is for, again, just as with the CFDs, is to basically make some money, right? For speculated purposes. That counts for about 90%, I would say, of the daily total volumes. The remaining 10% is usually for hedging purposes, and that is more for, some sort of requirement by some of the companies. So let's say, for example, a UK-based company has a supplier in Europe. So obviously they need euros in order to pay that supplier. So they have to go into the forex market to, do the exchange GBP into euros. So and then we'll do that for hedging purposes. And I don't want to go too much into that because it's a bit too complicated. So let's stick with the basic. So yes, the reason why most of all we like to trade forex is just to make some pennies. So yes. Also, forex is the largest and also the most liquid financial market in the world. That is because, as you can see over there, accounts for about $6.6 trillion of daily trading volumes. And that is quite massive, okay? And the reason why I'm saying this is because, just to give you an idea, obviously you hear a lot about the stock exchanges, Apple stock, Amazon, Facebook, and all these massive companies. Well, forex trading is about 15 times the size of the daily trading volumes of all the world's stock markets combined. Okay, so as you can see, it's pretty big. And also, like I mentioned before, one of the good advantages of forex trading is liquidity. So let's say, for example, you're looking to trade a significant size of euro versus US dollar. It will get executed quicker than if you were looking to trade the same size with Apple stock, for example. Okay, and the reason for that is because there's not so many players in the market in order to have that liquidity that in the case as forex will offer you. I'm not saying that with the stock market you don't have the liquidity, or particularly with this Apple stock. Of course, you have a massive liquidity, but in comparison with the forex market, it's pretty much not that big. So yeah, that's also one of the advantages of forex trading. Also, the market, the forex market is open 24 hours a day, 5 days a week. And I will, in the next slides, I will focus a little bit on the trading hours when it comes down to forex. Okay, and the reason for this is because there are so many events, so many developments that is actually happening. To say key developments that is actually happening during these trading hours, and that is the reason why I would like to spend a little bit of time explaining to you the importance of these trading hours, because once you know exactly what's happening during these trading hours, you can make a lot of money. So yes, so in here, let's go to the next slides. So as you can see over here, so basically the reason why the forex market is open 24 hours is because it will first open in Sydney, okay, and that is what we call the Asian session. So the first session would be obviously based in Asia, since they work out first than us. So it would be Sydney's business hours, then obviously Tokyo will be open. So that will be going on throughout the whole Asian session. Then once Asia, in this case Tokyo, business hour come to an end, then by that time Europe will be already awake and the business hour will be up and running. So what happens, basically the market simultaneously close and opens up again. So then we'll be focusing on the European session, that's how we call it. And once the Europe business hours come to an end, the American session, in this case, the New York session, by that time it's going to be almost midday in New York. So the market will again focus on the American session until the New York business hours closed. But what happens is, obviously, by the time the New York session closes, it's going to be on this side of the world in Asia, it's going to be waking up. So basically the market is like a little cycle, okay? So it's going to close and then open up again. Then we'll go to Asia, Europe, New York, and then again Asia, Europe, New York, all the way until Friday afternoon, 5 p.m. New York time, or 10 p.m. London time, depends where you're based, okay? So even if you're in Asia, it would then be Saturday morning. So yeah, so basically, essentially the market opens on let's say you're based here in the UK, so it will be from 10 p.m. on Sunday night all the way to 10 p.m. Friday night. Okay, so this is the reason why the market is open 24 hours a day. So let's now go with the events and developments that is happening during these 3 trading sessions. So let's begin with the Asian session. So much of this session, just before I go into this, let me check if there is any questions so far. Okay, perfect. I don't see any questions at the moment. So, okay, again, ladies and gentlemen, if you have any questions at the end of this presentation, I'm more than happy to answer any question that you may have. So, okay, let's keep on. So, with the Asian session, most of this session is focused on the Japanese yen currency pairs, since the size of the Japanese market and also the importance and the effect of the Japanese market has on this in Asia, right? So obviously most of the you happen to have any exposure to any of this market, particularly with the Japanese yen. Also, you have any exposure with the Australian dollar or the New Zealand dollar. You should look out for any information that comes out of any of these countries. So let's say, for example, for Japan, right? You should watch closely the Bank of Japan as well as the Ministry of Finance, particularly with any information regarding to exports and imports, as well as manufacturing and trade balance, okay? So as well, as you probably know, Japan is a highly export-oriented country. So any of this data might have an impact in the Japanese yen. So even though you might not have an exposure, that could be also be a trading opportunity as well. So once this data releases comes out, you can then put your trading plan into practice and hope for the best, I guess. So so again, with the Japanese yen, this might be affected by any of these data releases. Also, for the Australian dollar, you should look out for any data release coming out from the RBA, which is the Australian Central Bank. Any, anything related to the monetary policy, as well as changes in the interest rates, that all might have an impact on the Australian dollar. So if you have, again, an exposure, or you're looking to maybe there might be some trading opportunities, watch out for any information come from the RBA, which stands for the Reserve Bank of Australia. And the same would apply for the New Zealand dollar, okay? Any information coming out from the Reserve Bank of New Zealand, which again is the central bank over there. Any information you should keep an eye on, especially if you have any exposure, okay? And then sometimes all this information might have an impact on the currency, and some of the currency are kind of some sort of correlated. I wouldn't say 100% obviously, but more than 50%. So yeah, sometimes they move in the same direction. Sometimes, again, but I'm not going to go into that. So I just want to give you a brief explanation of how they work. Sometimes the currency pairs when all this data come out. So that is basically what you should be focusing if you are interested in the Asian session. Once the Asian session is closed, then the main focus would be on the European session, which, by the way, accounts for more than 50% of daily trading volume. So as you can see over there, is when the market, the liquidity is at its peak. So yeah, like I mentioned before, it accounts for more than 50%, and I think the Asian session is about 21 or 22% of daily trading volumes, and the remaining will be then on the New York session. So yeah, so with the European session, you should really keep a close look of at any events that will happen during the day, as well as throughout the week. But essentially, with any data release coming out from the European Central Bank, that should be enough though. But sometimes you should be aware of any data coming out of Germany, for instance. And the reason for that is because, as you probably know, Germany is the largest country, the largest economy in the Union. So any data might have a great impact on the euro, especially if it's not expected. So, for Germany, any data related to manufacturing as well as the GDP might have impact on the euro, maybe not, but, depends on what is happening in the market and what is the market expecting. So just bear that in mind, but yeah, in general terms, any data release or speech coming out from the European Central Bank, particularly its president, Christine Lagarde, will be important to watch, such as the interest rate decision. This usually happens on a Thursday, not every Thursday, sometimes. So you can find this on the economy calendar. It's one of the trading tools that we currently offering to our clients for free. So you can go to your portal if you are a client, and in there you will be able to find the economic calendar. You can basically plan your week ahead. Don't have to be particular for that week, but let's say on Friday or Saturday, you might log in into your portal and plan your week, your trading week ahead. Okay, so to be aware, and then you can also set up some sort of alarms and notification to let you know what's, like a reminder of what is going to happen on that particular day. Okay, and also you will be able to see the time too, so which is very important. So so in regards to the European Central Bank, any speech based related to the monetary policy, where usually the president of the European Central Bank will announce the deposit facility rate, also the marginal lending facility rate, and most important, the interest rate decision will all come together in the same speech for that particular day when it happens. And obviously the market will always be closely looking and watching these speeches. And the reason for that is because, well, you kind of want to have an idea of how the European Union economy is doing, particularly, for everything that has been happening with COVID-19, with all this pandemic that has been affecting so many economies out there. So obviously, it's very important right now to see, if finally we're going to be moving, growing, right? Since that has not been the case in the last 12 months. So obviously the market, for that reason, will be watching closely European Central Bank, not just in Europe, but all over the world, okay? Particularly the big ones, the European Central Bank, the Fed in the US, and also here, well, the one in Japan, and as well the one in England, the Bank of England, right? Especially if you have any exposure with the pound sterling, you should also be looking at any speeches coming out from the governor of Bank of England, Andrew Bailey. Which usually he normally speaks on a regular basis, I would say, and he gives his remarks on what's currently happening in the markets and also in the UK economy. So you have to have some sort of insight and to understand a little bit what the central bank in the UK is thinking. Also, it would be good, to hear and at least to read any of his speeches. So yes, and then again, you can take that into account when you're doing your trading strategy. Okay. So just to conclude with the European session, any information that you should, any data that should be, and report that should be looking at, I would say obviously the European Central Bank interest rate decisions and press conferences. Also any speeches by any of the European Central Bank official, which they do sometimes. Also the European Consumer Price Index, in other words, the CPI, as well as the PPI, which stands for the Producer Price Index. All that data usually is very important to have a look. Also, the industrial production, the retail sales, and very important too, the unemployment rate. Okay, so that is basically it for the European Central Bank. Now, obviously, once the Asian session is closed, European session is closed, well, the only last remaining session open is the American one. So as I mentioned before, so now it is pretty much similar as the previous two sessions. You should look out for any US economic and data reports that comes out throughout the New York session, essentially the Fed speeches, which is the central bank in the United States, or the FOMC meeting. The FOMC, FOMC, stands for the Federal Open Market Committee, whose members are actually responsible for the monetary policy in the United States. So that is why you will hear, or you have heard a lot about the FOMC meetings and the press conference and so on, is the reason why is because they are responsible for the monetary policy over there. So again, when you hear that or that one is coming up, which is the case of this week, by the way, just keep an eye, because usually market will be watching very, very closely what they have to say, particularly with right now, whether I'm going to have a hawkish view or more a dovish view, so all this kind of interpretation, market will be having a close look, and based on that, people will make their own trading strategy and decision based on what they understood or can see happening in the near future. Okay, so that is basically what I wanted to explain to you guys, ladies and gentlemen, about the importance of the trading hours, particularly when you're trading Forex. And also, the last thing I forgot to mention, if you have any exposure to the particular stocks, just bear in mind, because particularly right now is the earnings season, so where companies report their financial statements. And this will happen, usually it will depend. Some of them are basically out before the market opens, and some of them, which was the case of Tesla, for example, last night, it will be open after market closes, so that is after 9 p.m. London time. So as you can see, all this will have an incredible impact on the stock price, which is in the case of Tesla. For example, last night they reported higher than expected revenues for one of the main reasons, because one of the cheapest models did very well. So in terms of sales, so that is actually already affecting the price of Tesla stock. And even though they call it pre-market hours, so once the market opens, which is right now the case, or more people start trading into, and then the price might just carry on going up, right? So yeah, so just bear that in mind, because this usually happens when the market's actually closed. So just bear in mind, okay? And finally, for those of you who are interested to know what is to watch this week, well, I would say tomorrow, 2:30 a.m., I think that's London time, and the Australian CPI will be released as well tomorrow. The core CPI from Canada as well, that would be at 1:30 p.m. London time. And then a few hours later, at 3:30 p.m., it will be the weekly US crude inventory. So if you have any exposure on oil, WTI, or you're looking to trade that, might want to know what the data will be tomorrow. Then also later on in the day, at 7 p.m. London time, it will be the Fed interest rate decision, as I mentioned a few minutes ago. That will be tomorrow at 7 p.m. And then on Thursday, we have the German unemployment rate, and that is before 9 o'clock. I think it's around 8:50 or 8:55 a.m. London time, this London time. And then later on that day at 1:30 p.m., it will be the US GDP. And then we will have later on at the end of the week, we have the German GDP, the Canadian GDP, and the European CPI and GDP. And that will be on Friday afternoon, okay? So that is basically it with the trading hours. So if you have any questions so far, please do let me know. Okay, great. So so far, no questions. So again, as I mentioned a few times already, if you have any questions, you can also ask me at the end of the webinar. So okay, now let's go to the other part of Forex trading, is how to trade Forex. So the main thing you have to first look at is at the currency pairs, okay? So we're just gonna take the same example, the euro versus US dollar. And if you're wondering why I always take this as an example, is because the euro versus US dollar is pretty much the most traded currency out there, okay? Everybody has trade the euro versus US dollar. It's also known as a euro dollar. So yeah, everyone trades that. Your friend, your family friend, your parents, everyone who's actually trading has traded or is currently trading the euro versus US dollar. Okay, so and that's why I like it too. So Yeah, so the first thing that you have to look at, as you can see over here, is the base currency and the counter quote currencies. Okay, and the first thing you need to find out what is so important is because in this case, with the base currency, it basically will tell you the denomination of the trade. So with this example, you're looking to trade one standard contract, and in the next slides, I will give you the different contract sizes that are, but the largest one is basically the standard contract. That's how it's called, and it's worth 100,000 units. So it will be units because it will be based on the base currency. So if you're trading, as in this example, the euro versus US dollar, it would then be 100,000 euros. Okay. So since the euro is my best currency, and then with my counter or quote currency, it basically will tell me the value of my profits or losses. So any profit or losses will be based, or sorry, I should say the p value, which I didn't want to get into that because I will explain that to you in a bit. So, but yeah, let's just say the p value will be based on my content quote currency. Okay, so just bear that in mind when you're trading. And normally, well, usually the platform calculate all this automatically, but it is very important to you to know and understand this very well, because the last thing you want is to start trading when you don't have much of idea what you're doing. Okay, you need to understand exactly what you're doing. Okay, that is one of the key to success in trading. Okay, make sure you understand what you're doing, particularly because when you're going to be doing your trading strategies, and you're probably going to be calculating all this, right? So for example, your risk management. Okay, when you're going to be trading and euro US dollar, and you want to open a few standard lots, few standard contracts, you probably want to put your stop loss, which again, I will explain this in more details tomorrow. So if you're interested into that, please do go to our website and sign up for that webinar. It's actually called How to Trade on the MT5. So yeah, in there I will be explaining in more details what I mean by risk management and all these trading strategies. So yeah, so obviously you want to calculate all this. So one of the reasons is to calculate just how much are you willing to risk when you're opening any position, really. So you need to know all this, the base currency and the counter quote currencies, okay? Because that will tell you a lot of things that you should know when you're doing your strategies, right? So yeah, so that is basically how it is. Obviously, you also see a lot of, for example, the US dollar as my base currency versus, for example, Japanese yen. So then my Japanese yen, the yen would be then my counter currency, okay, and so on. So, but let's take one example to not get too confusing over here. So, yeah, so that is my base currency, which essentially tells me the denomination of my trade, and my quote currency, which basically tells me the value of my pip, the pip. Okay, so now these are the contract sizes I was telling you before. You have essentially three types of contract size. The first one is a standard contract, or also lot. It's also another trading terminology. But yeah, one standard lot is the largest contract size when you're trading CFDs. So as you can see over there, for currencies, it's 100,000 units, or in other words, your base currency. So let's say it was euros in my previous example, so it would have been 100,000 euros. Then you have your mini contract. You can see over there is 10,000 units, and my micro contract, which is 1,000 units. And for the gold, it would then be for one standard contract is 100 ounces, for the mini contract 10, and for the micro contract 1 ounce. Okay. Then for the silver, it's slightly different, as you can see on the table. So one standard contract silver is worth it's actually 5,000 ounces. For the mini contract, 500 ounces, and for the micro contract, 50 ounces. Okay. And for the oil, as you can see over there, the standard contract is 1,000 barrels. For the mini contract, 100 barrels, and for the micro contract, 10 barrels. So again, ladies and gentlemen, memorize this table because that will help you a lot. Particularly, as I was saying before, when you're going to be doing your risk management and your trading strategy, you need to know this because this is basic. Okay, this is the what you need to do in order to understand even the most complex things. So this is just a basic, okay? So please do memorize this, and don't have to be obviously right now, but you know, when you're gonna be, for example, if you haven't traded before and you now want to get into trading, you're probably gonna go for a demo account, okay? Well, know this, because even in the demo account, you need to understand what you're doing, particularly in the beginning, because in the beginning, I understand, because we all have been there. It could be very confusing. So from my experience, I would say to understand, memorize this, because it will help you a lot. So that is basically for the contract sizes. Now, if you guys can recall a little bit what I mentioned about 5 minutes ago, and the p-value, okay? So obviously you're probably wondering, well, what is a pip in the first place? So this is what it is. So a pip is the smallest increment in price fluctuation in currency prices. It's also a hundredths of percent, and it's the fourth decimal when you're looking at the prices, okay? So here's a little example, as you can see. So let's say the price of the euro dollar is 1.1801. So since this number is my fourth decimal, that would be my pip, okay? So every time this number goes up and down, that would be 1 pip more, 1 pip less, etc. Okay. Then if then 0 goes up, okay, that would have been 10 pips. If the number 8 goes either up and down, it would then be 100 pips. And if the number 1, so the first decimal, goes up and down, it would then be 1,000 pips. Okay. And now you wonder, okay, perfect, Guillermo. Now I understand what is a pip. I know it's a full decimal. I know that, but how much money I will be making every time the price goes up or goes down? Depends on what type of position you have, either it's long or short. What is the value, right, of that particular pip? You know, well, this is the pip value of when you're trading CFDs. Again, like I mentioned in the previous example, in the beginning, when I was telling you the euro versus US dollar, the pip value will be based on my counter currency. Okay, so just bear that in mind. So here, to make things simpler, I just put in dollars, because the previous example I just gave you with the euro versus US dollar. But then, so as you can see over here, the pip value for currency is $10 per pip for the standard contract. So as you can see, and you probably notice, it does vary a bit depending on the contract size. Okay, so for the standard contract, it's $10 per pip, but for the mini contract would then be $1 per pip, and for the micro contract would be 10 cents per pip. Okay, so as you can see, it's again very different, so just bear that in mind. Obviously, there is a reason why it's $10 and $1.10, but again, I just want to make things simpler here. I don't want to go too much into the technical part behind it, and why it's $10 and why it's not, for example, $11 or $15. Okay, so there's a reason why it's $10, but you know, the main point is basically every time you trade the euro versus US dollar, one standard contract, the value of the pip every time goes up or goes down, it would then be worth $10. Okay, then for example, if you're looking to trade the US dollar versus the Japanese yen, and obviously the value of my pip would be different. It would not be $10. It would then be, for one standard contract of the US dollar versus Japanese yen, it would then be 1,000 Japanese yen. Okay, which essentially comes back to, you know, to do the conversion of that, it would be something close to $10 anyway. But you know, I just wanted to give you some of the you know, differences sometimes when you're trading of the quote currency. But let's stick with the basic. So it would then be $10 per pip for the standard contract, $1 for the mini contract, and 10 cents per pip for the micro contract. For the gold, that doesn't, you know, same price anyway, that doesn't change. It would then be $10, similar as the currencies. For the standard contract, and for the mini contract would then be $1 per pip, and for the micro contract would then be 10 cents per pip. And the same will go for the oil. Okay, as you can see up there, for the standard contract is $10 per pip, the mini contract $1 per pip, and for the micro contract 10 cents per pip. And then I would say for silver is slightly different, because you can see up there is $50 per pip for the standard contract, for the mini contract $5, and for the micro contract is 50 cents per pip. So, you know, just as the same with the contract sizes, it would be ideal if you can memorize this little table, because that again will be helpful when you want to calculate, especially when for your risk management, how much, as I mentioned before, if you can recall, you want to see how much you can risk, how much you can lose for that particular trade. So obviously for that, you need to know the p-value, okay, for that particular instrument. So, okay, perfect. So moving on. So what is now a spread? And this is essential to notice, because the reason why is because the spread is essentially the cost of the trading. There's a lot of brokers out there that might tell you we have no commissions, so good, right? But no, there is actually a cost, and that is what we call a spread. And what is a spread? It's essentially the difference in the bid and ask price. So what is a bid price? It basically represents the price at which a broker is willing to buy. So as you can see here in this little table, it would be here sell for you. And the ask price represents the price at which a broker is willing to sell. So in other words, it is one over here, okay? So as you can see, the difference between this price and this price is a spread. So that is the cost of trading. So that will vary depending on each broker. And in order to find out the spread, you can either calculate it yourself, or as you can see over here, you can see already here, this says Fraser 18. That is 18 points, okay? That is because that's how it's by default in the platform, in the trading platform. But if you want to calculate that in pips, all you have to do is use a 0 to the left, and then you will have your number in pips. So in this case, with the 1.8 pips. And the total value for the standard contract would then be $18 and the cost of that particular trade. But again, this will depend on the type of account that you have, particularly here with the CFI Financial. We have two types of accounts. So we have the standard one, we have the premium one. So they all come with different features and characteristics, and also the spread will be different. So the cost of trading as well. So again, if you would like to know more about that, would like to get more information about the different types of accounts that we're currently offering, please go to our website, cfifinancial.com, and in there you will be able to see basically all the information that you need to know, not just about the different account types that we offer, but also the instrument that we currently offer, over 7,000 instruments right now. You also can see everything, the regulations, all our entities, since we are a global company. So you can see all that in our website. So if you want to find out more, please do go to our website, cfifinancial.com, and in there you will have all the information that you actually need. But yeah, so essentially this is what it is, that the spread. So it's just basically the difference in the bid and ask price, okay? Now, before I conclude with this presentation, the last slide is about swap rate and rollover, or rollover is also known. And that is basically swap rates. Remember when I said in the beginning of the presentation that with CFDs just do not have expiry date? Well, every time you hold a position overnight, so that is after 10 p.m. London time, or in other words, midnight server time. And just in case you're wondering what is a server time, usually in the platform, you will be able to see it. So as you can see over here, market watch, 5 p.m., almost 5:30 p.m. That's server time. So obviously, if you're based in London, that would be a couple of hours before, right? So it depends on the summertime. So it could be a couple of hours or 3 hours. But it's very important that at least you know that your server time you can see in the platform. But either way, it's always going to be 10 p.m. London time. So after that, you will either have to pay or you have to earn an interest by holding a CFD position overnight, okay? So in the case of Forex, for example, usually if you hold a position, you go long and you hold it overnight, you usually earn an interest. And if you go short, you usually have to pay. But there could be the cases that even though you're still long for that position, you still have to pay an interest, okay? And you can find that information on the website. Every single broker has to explain that, so you will be able to see it as well. And then in the platform as well, on the product description, you will be able to see the swap rate for that particular instrument as well. And again, well, and also, ladies and gentlemen, this will be based on each particular circumstances, because there could be the case that sometimes you might not be able to pay for the swap rate. But again, this will be down to your own circumstances. And if you want to find out more about it, please do contact your account manager or your, your broker to find out more about this. And also, one last thing about rollovers or swap rate is that if you hold the position overnight or Western night, you will get charged or get paid or earn. Sorry, you get charged or get paid 3 times. And the reason for that is the weekend rollover. So Friday, Saturday, and Sunday. But if you happen to close your position by Friday night or Friday, you're only going to get charged once, okay, rather than 3 times. So yeah, I just want to give you that little information about swap rate. Okay, I'm having a few questions right now, but before we go into that, I will answer them at the end of this webinar. So do not worry about it. I will answer them, but since I'm already finishing with the webinar, let me go with the last 2 slides, and then I'm more than happy to answer the couple of questions that I can see over here. So for those of you who don't know who is CFI or who we are actually, well, we were established in 2005, and since then we have been expanding worldwide to the point that right now we have 6 offices right now. You probably guessed it, we are an online forex broker offering essentially CFDs. For those of you who are interested, we have 2 platforms. One is MetaTrader 5, which is commonly or widely used by many traders. We also have another more advanced for professional ones. Usually, it's called CTrader as well. So again, you can find all this out in our website. Then we are also a fully regulated company, so which is very important for you, ladies and gentlemen, because you want to have, make sure that you are protected, right, by the regulations. So we have an office in Lebanon, obviously the one here in London. We have our headquarters in Dubai. Then we have another office in Jordan, Mauritius, and Cyprus, and we are regulated by all the financial regulators for that particular jurisdiction. So as you can see over here in the UK, we are regulated by the FCA. In Lebanon, we are regulated by the BDL. In Dubai, we are regulated by the DFSA. In Jordan, we are regulated by the GSC. In Cyprus, we are regulated by the CySEC, and in Mauritius, we are regulated by the Financial Services Commission, Mauritius. Okay, so yes, as you can see, we are a very trusted broker. And if you haven't had an account with us, probably you should, since we have all the basically protection that you're probably looking as well. It's not just about the trading costs and the instrument. Again, we offer over 7,000 instruments available to trade, which not every broker does. So, there's also a good thing about it. So yeah, again, you can go to our website, find out more about us. And if you're interested, it's very nice and easy to open an account with us, okay? And we also have available for demo account for free as well. And this is basically all the products you can trade, all the way from futures, options, also shares, forex, commodities, metals, oil, and some bonds. And also, if you are looking to trade an account, have an account with CF5 London, you have a leverage up to 400 to 1 if you qualify as a professional. Otherwise, it will have then be up to 1 to 30. This is all down to the FCA rules. Then the spread depends on the type of account that you have. It could be as low as 0.0. We also offer fast execution, which is, I guess, very important for you guys. That when you trade trading, you try to avoid some sort of slippage. So yeah, we do offer a very fast execution service. Then we also have a customer service available 24 hours a day, 5 days a week. And if you don't have it, or if you don't follow us on social media, please do. Since in there we do usually give any updates regarding to the company services or news as well. So we have Facebook account, Instagram as well, and well, LinkedIn, Twitter, and also we have a YouTube channel where we usually post some sort of videos, particularly about concerning trading. So please do so. And also, if you would like to get in touch with me about anything regarding to CFI or trading as well, you can also contact me on my email at g.sanchez@cfifinancial.com. So, if you have any question or would like to speak to myself, please do so, and I'm more than happy to speak to any of you. Okay. And with that, ladies and gentlemen, we have concluded with today's webinar. I hope you enjoyed. And before I close everything out, let's answer the couple of questions that are so ready. Again, if you have any questions, please do so before I go. So the first question I can see here, what is the difference between the sales and buy price? It's basically when you're trading, and you will have two prices. And let me go back to that slide. So you, as you can see here, you will have two prices. So let's say you believe that the price of the euro versus US dollar will go down, and let's say for the next hour or so. Obviously, you're looking to sell, right? So that is the price is going to be sell at, okay? But let's say, for example, that you believe that the price of the euro versus US dollar will go up, then you will buy, right? And this will be the price you're gonna, the broker is willing to sell you at. So you're gonna be buying at this price. So that is basically the difference to the sell and buy price. We also call it bid and ask prices, okay? So here's what the broker is willing to buy in case you're looking to sell, and here's what the broker is willing to sell. So in this case, you're looking to buy, okay? For this particular instrument. So I hope that is clear. Okay, about the other questions. So basically is when I should sell and when I should buy. With that particular question, I cannot really answer them because we cannot really tell you when you can buy and when you can sell. All I can tell you is obviously that will be down to yourself. Based on your, you have any sort of trading strategy, risk management, and you are, it would depend if your trading strategy is based on fundamental analysis or technical analysis. Then based on that, you can make your own decisions and, and whatever is happening right now in the market for that particular instrument, and you can then buy or sell. But that would be down to yourself. Here at CFI, we do not provide advice. So we can't really tell the clients what to do. All we could do is try to, as I've been doing with this webinar, explain to you the basic of CFD trading. Then obviously if you want to speak to them about the markets, yeah, I'm more than happy to do so. Of any data release that has been out there, you can want to discuss that, yeah, we're more than happy to do so. But we cannot tell you what to do when it comes down to your trading, okay? We can't tell you just go and buy. We're not allowed to do that. So I just want to make that clear. Okay, so regarding to that particular question. Okay, perfect. If there is no more questions, you're welcome. Thank you very much. Okay, so yeah, it has been a pleasure once again. I hope you enjoyed today's webinar. And again, if you're interested, tomorrow we'll be running another webinar about how to use the MetaTrader 5, which is a trading platform, one of the trading platforms that we're currently offering. So yes, if I don't see you there, well, I hope you have a lovely day and see you next time. Goodbye.